Good day to Professor Jeremy and all others. I am Sivam from Wisdom Group and would like to do the introduction for our presentation today. Today, we would like to do a presentation regarding an analysis of ABC Berhad financial performance over the past 3 years. We will cover a few ratios such like liquidity ratio, activity ratio, financial leverage ratio and profitability ratio, and also the market ratio. Let me start with the liquidity ratio. The current ratio, which measures if the company has enough resources to meet its short-term obligation, has dropped from 2022 to 2023, which means the company is more capable of paying its obligation, where the quick ratio of the company initially dropped from 2021 to 2022. Which show the company suffers to raise the cash to pay to the creditor.
Hi, myself Sundaresan. Okay, I will be analyzing ABC's activity ratio. This ratio measure the efficiency of a company in managing its resources to generate a maximum revenue. Okay, inventory turnover ratio, which measure how efficiently the inventory is managed, declined in 2022. That show the company has lower sales or excessive inventory. However, it's improved in 2023. This indicate they are improving the sales. Okay. Secondly, the average collection period shortened means the company collects the payment faster and efficiently. Moreover, the company also experience shorter average payment period. Okay, this show the received payment from the customer much sooner. Total asset turnover in 2022 is too high, which show ABC had influx of sales. The drastic drop in the 2023 show that ABC couldn't replenish their inventory in accordance to the demands.
Okay. Myself, Ganesan, will be explained on the financial leverage ratio that measure the company level is reliance on borrowing and how the effective utilize debt to generate revenue. Debt ratio, the company asset to debts. Okay, the continued drops in the debt ratio show that the ABC has more the asset than debts over the years. Furthermore, the debts to equity ratio, which have measured financial risks by the comparing the total debts or obligation to shareholder. Equity account over the 3 years, the debts to the equity ratio increase, which means the company keep borrowing capital from others' financial is a growth. In addition, the time the interest earned the ratio that indicated the ability to pay the debts, the 17.02 in the 2022 indicated to investor to the company is the overly risk averse. The ratio drop drastic in the 2023 show the ABC could be at the risk of the defaulting.
Hi, greeting to everyone. I am Thanarajan here, generally to evaluate the company ability to generate income compared to expenses. We use profitability ratio. The continuous drop in gross profit margin shows that ABC company revenue might gone down or the cost might went up. On the other hand, the operating profit margin also dropped over the 3 years, which means the operation and non-operating costs too high. Note that the net operating margin decline, which show ABC might use inactive cost structure or poor pricing strategies. Moreover, the return on asset decrease over the 3 years, which indicate the company might have over-invested in assets that have failed to produce revenue growth. Fifthly, the return on the equity improved in 2022 show the company converted its equity into profit. However, it couldn't sustain and faced a drop in 2022. Lastly, earnings per share improved over the year, which may attract more investors, and higher EPS indicate greater value.
Good evening, dear friends. Kannan here. It was a contentful analysis. For my part, I will be taking on the market ratio when it's equally important as other ratios. Market ratio analysis, stock prices. Okay, PE ratio of ABC dropped over the 3 years. This happened because ABC probably undervalued their stock. However, the market ratio gone up over the 3 years, which isn't an attractive figure for investors as the ideal. Otherwise, it is overvalued. We found a few recommendations to improve the following ratios. To improve the liquidity ratio, the company can actually control overhead expenses, and they also can sell unnecessary assets. Secondly, to improve activity ratio, the company can actually accelerate receivables collection and reduce inventory level and increase inventory turnover, which is basic for any other company. They can actually do the benchmarking with the company in the industry. Thirdly, the financial leverage ratio. They can actually, to improve this financially leverage ratio, company can immediately pay off an existing debt and application on its balance sheet. Not only that, there are few ways to improve the profitability ratio. You can actually boost the productivity, and the company can also introduce some attractive marketing strategy, and also they can conduct some market research to improve the sales. Last but not least, to improve the market ratio, the company can actually build market share, and also they can acquire competitors. Thank you.
Hi, I'm Siva here again. I will be explaining question 2. As per stated in question 2 requirements, the projected sales of 2024 is 6 million. The cost of goods sold include 1 million of fixed costs, which means we have to discover the variable cost on our own. Secondly, the operating expenses includes of 2,500,000 fixed costs. Moreover, the trade receivable, trade payable, other current liabilities will change in direct response to the sale, which is 6 million. So the variable cost according to the 5 million sales will be 35%, whereas the operating expenses variable cost will be 12%, will be directly applied to 6 million in 2024. The change in accounts receivable in 2024 will be 12.5%, from account variable will be 14%, and for the current liabilities, it will be 0.1%. Let's start with sales revenue of 6 million for the provincial import Berhad statement of comprehensive income for the year ended 31 December 2024. The operating profit of the company is 1.93 million after deducting 1 million of fixed costs and 2.1 million of variable costs from the cost goods sold, and also 250,000 fixed costs, variable cost of 720,000 from operating expenses. And also, after deducting the interest expenses and also depreciation from the asset we stated earlier in the depreciation expenses of the year, 110,000 according to the statement given in the official requirement, the tax will be applied at 40%. So we have to deduct the 648,000 from the net profit, which is the taxable amount, and for the cash dividend is 40%. That's how we got the return earning of 583,200. Thanks.
Okay, thank you, Mr. Siwa. Okay, I will be presenting on the balance sheet of a Provincial Import Berhad for the year end 31st December 2024. Okay, the cash recorded at 400,000. It's because it double of the 2023 year. Okay, the marketable security is 225,000 and the account received is 750,000. Okay, directly apply from work done before. Okay, the inventories is 1 million, so the current asset will be at 2,375,000. Okay, the non-current asset, which is fixed asset of the company, is 1,646,000. Okay, because the balance brought forward, is 1.4 million. Okay, during the year they had addition of a fixed asset which is 356,000. Okay, the 356,000, and the depreciation expenses of the year is 110,000, which will be deducted from the non-current asset, and also have to add back this 110,000 in our statement of comprehensive income, is because it will be fell under operating expenses. Okay, so the total asset will be 4,021,000. Okay, 21,000, and for the account payable it will be 840,000. Okay, and the tax payable will be taxed at 40%, which is 259,200. Okay, 259,200. Okay, and the notes payable is 200,000. Other current liability will be recorded at 6,000. So the total current liability will be 5,200. Okay, the current liability. For the long-term debts, the company had 500,000. And for the common stock, they have 750,000. Okay. The retaining earning, we have marked at statement of comprehensive income, and the previous year retaining income, we will get 1.9 million 58,200. Okay, that will be the external fund, and the external fund required is 182,600. Okay, thus the total owner's equity and liability will be at 4,021,000. The end of the total asset must be tally with total owns equity and total liabilities, because the accounting formula is equal to accounting formula is A equal to OE plus L, which means the asset equal to total owner equity and liability. Okay, so that's about the balance sheet.
All right. Again, I'll be presenting on ways to raise external fund. Okay, there are many ways to raise external fund. For instance, IPO, which is also known as initial public offering. Initial public offerings is an opportunity to obtain capital by offering shares throughout the primary market, and it's also an exit strategy for the company, founders, and early investors, realizing the full profit from the private investment. And secondly, angel investor, also known as individual investors. These individual investors who are interested in funding business, they believe in providing attractive returns, and these individual investors will lend fund in exchange for an ownership stake in the company. Okay, and then lastly, apply bank overdraft facility. Okay, bank overdraft facility and overdraft is available amount of borrowing agreed with bank up to set a limit, which mean, for instance, if we have bank account with certain banks, we can apply for overdraft, which is also known as loan.
But this is not credit card or direct loan from the bank, which falls under the long-term liability. This bank overdraft will only falls under current liability, which is payable within 12 months. Thank you.
Okay, that's all
You guys.
from our Wisdom team. Thank you so much.
Okay,
Thank you
bye-bye.
so much.
Thank you.